Let's now reintroduce our panel to viewers and listeners out there. We have David Kelly, JPMorgan Asset Management. We've got Kristen Bitterly, head of investments at Citi Global Wealth. We've got Jim Caron at Morgan Stanley Investment Wealth Management. He's the chief investment officer there. And, of course, our own Rick Santelli and Bob Bassani as well. Let's go right out to maybe, Kristen, to you first. We've now had a chance to kind of, at least first blush, take a look at this statement. There have been some notable changes there. Do you feel as though this particular statement then changes your outlook, your models for the balance of the year? The markets did move lower for stocks, but not significantly so. So maybe there was just an incremental amount of development with regard to expectations.
This, for us, it doesn't change anything simply because our base case is that the earliest we would see the first rate cut would actually be in June of this year. So I think when we hear what was said in the statement, it really is kind of walking back and giving the Fed some flexibility because there is a lot of data between now and March. And going back to something that David said earlier, when we look at the resiliency of growth, when we look at the GDP number, the strength of the consumer, the strength of consumption, there's a balance that the Fed has to strike there. So I think pushing back a little bit on the market in terms of anticipating a March rate cut and really kind of setting expectations that this is something that's certainly going to happen this year, but it could be more realistic for us to see more of a deterioration in the data or maybe not as strong of a growth picture as what we're currently seeing.
David, I want to go to you. I wrote down as you were giving us sort of your expectations or what you would hope to hear that you wanted Powell to admit the economy is growing faster than expected. What do you make of what you actually heard from the statement before we hear from the man himself?
Well, I think that is pretty much what they said.
Yep.
I mean, I think it was trying to push back on a rate cut in in March. And I think it really is setting the table for first rate cut in June because the March meeting, they put out forecasts, but are they going to get enough information between now and then to really want to say, hey, now they think there is enough sense that inflation is headed towards 2%. So they'll probably punt there. Then they don't want to do it in early May because they won't put out new forecasts. So it sounds to me like June, September, December is what they're thinking, 3 rate cuts this year, provided the economy keeps growing. And, this is good. And the other thing is they put in a phrase about the balance of risks. And I really think that's what they're looking at here. There doesn't seem to be at the moment a sign that the U.S. economy is going to keel over and fall into recession anytime soon. And until they see greater damage or potential damage to the economy, given the huge run-up in markets we've seen, they just, see the balance of risk more being on the side of inflation being sticky than the economy falling into recession. And that's why I think they're being hesitant to have near-term rate cuts.
All right, Jim, let's go to you with this. You have argued, or you've made the case, that the Fed should start cutting rates sooner rather than later. A lot of economists are now tilting towards that summer time frame, May to kind of July. You think that maybe it should still be in March. Is there anything in this statement that kind of puts you at ease, or do you feel as though they should still go in March?
Well, I think Steve Leisman nailed it because the question is, Mr. Chairman, what gives you the confidence to start cutting rates? We already know inflation's coming down. The 6-month annualized average of core PCE, which is their measure of inflation, is already at or below 2% at this time. So I think the answer is, what gives you that confidence is that the labor market has to start to get weaker, because what's been happening is inflation's come down, but the labor market didn't get weaker. So therefore, they believe that the decline in inflation at this time might not be anchored, so therefore it might be too soon. So we have a payroll number coming up on Friday. Look, we'll see where that comes out. But I think the strength of the jobs market is now going to be something that they probably hinge off of. So, look, should they start cutting in March? It's probably 50-50. Does the statement seem like they're kicking the can down the road a little bit? Yes, it absolutely does. But I do think that they want to cut, 75 to 100 basis points this year. They like to get the ball rolling in March as long as the data cooperates. So it really is down to the labor market at this point, in my opinion.